Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we're going to be talking about the ATR swing trading strategy. Now, this is a powerful method that uses the average true range indicator to help you navigate the market volatility with precision. Now, if you have ever struggled with setting stop losses, identified optimal entry points, or managing risks effectively, this strategy could be the solution you have been searching for. So why not stick around until the end of this video to learn how to use the ATR to refine your swing trading approach and avoid common pitfalls that many traders face when trading. So let's get started. We start by understanding what the ATR, and this is a technical indicator that is used to measure volatility. Unlike indicators that focuses on price direction, the ATR provides insights into the magnitude of price movement, helping traders understand how much an asset price has to fluctuate over a given period. This makes it particularly valuable for assessing risks and setting stop loss levels. How does this ATR works? It works it works and it helps to determine it is determined by finding the largest value among the following: the difference between the current high and the current low. It helps to determine the difference between the current high and the current low. It also helps the absolute value of the difference between the current high and the previous close. Thirdly, the absolute value of the difference between the current low and the previous close. Now let's dive straight into how we can use the ATR for our swing trading strategy. So we're going to use a step-by-step guide on how to use the ATR effectively in our trade. Now we start by identifying the trend of the market. And as we can see in this area of the market, my 4-hour time frame, since we are swing trading, we'll use a higher time frame like your daily, your 4-hour, and so on and so forth. We can identify with this trend line that we are trending to the upside, creating higher lows, and we are expecting this trend line. So this can tell us, yes, that we are in an uptrend. We have to analyze the market trend. We can also make use of our moving average to determine the direction of the market. We can also use our trend line, and the ATR actually works best when combined with a clear directional bias. Now, trading in direction of the trend always increases your chances of success. That's why we drew this trend line, to give us a direction of the market. Now, the second step is to set your ATR indicator, and if you can see on my screen, the ATR indicator is on my screen. You have to make sure that it is at a 14 period length. This is the default setting. So when you add your indicator, you make sure it's at the 14 period default length, which is the standard setting. And this will calculate the average volatility over the last 14 candles. Now, the third step is to determine your entry point. Now, you use the ATR to identify potential breakout opportunities. Now, a sudden spike in the ATR often signals increased volatility. When you see a sudden spike, like in this area, you can see there was a spike to the upside. This means that there was a sudden increase in the volatility of price, and which usually precedes price breakout. When you see a spike, it usually signals price breakout. Now you have to combine this with price action or other indicators like support and resistance level to enter your trade. Now let's look at this area. Remember, price is respecting the trend line. We can wait for price to break this area in the market. We can wait for price to break this area in the market to be sure that we can take a long trade. When price breaks this area in the market and came back to retest, followed by a spike, and as you can see in the indicator at this area, there was a spike, which shows that there was an introduction of volatility to this market. So after the spike, coupled with our candlestick pattern of our bullish engulfing, we can enter our trade at that area. This is where we'll be looking to enter our long position once price has broken out above our resistance level. Don't forget, we have to combine this with support, resistance, or other indicators. So because I'm using our resistance level, once price broke above my resistance level, our resistance level combined with our ATR indicator, this our spike in our ATR, this further strengthens the entry of our trade. Now, how do we set our stop loss or our stop levels using the ATR? The ATR is highly effective for setting stop loss level that can account for normal market fluctuation. Now, we can usually use an entry. We can just, okay, this is an area where I entered the price. I entered at 1.06293. This is where I entered. You just need to add that, you just need to subtract this ATR value at that area. When price was at my entry, when price is at my entry, this 1.06293, this our ATR value that reads 0. This ATR value at that area, let's look at this value at this area while I'm at this entry. The value you get that price showed at the value that price shows at this ATR indicator, you would have to subtract it from your price entry point. Now I entered at 1.06273. You subtract that, you subtract this number from, so when it's subtracted from your entry, you can use that value as your stop loss level. That should be your stop loss level. Let's make sure that we understand what we are saying. This means that your value of your entry, where you entered at 1.6312 minus, we subtract this from this ATR value over here, that's your 0.0023. You subtract this number, and whatsoever number it gives you, this will give us approximately 1.0594. And if we place our stop loss at that area, 1.0594, this will be where we will put our stop loss. And you can see price did not come back to that area after we entered our trade, and we can aim for our 1:2 or 1:3 risk to reward ratio, as the case may be. So this is basically how to use your ATR to set your stop loss levels. You can also use your ATR to determine your position size. That's our step 5. Meaning the ATR can help us determine how much risk you should take on each trade by adjusting your position size according to volatility. The formula is the position size equal to your risk, whatever you want to risk, divided by your ATR times your multiplier. That will give you the position size you should use for that trade. Last step is you can also use your ATR to set a realistic profit target. Realistic profit target, you can always use your ATR for that. You just need to get your entry price. You get your entry price, you add it to your ATR value at that entry price. Whatever value you see here when you enter the trade at this area, you just add that value, you multiply it times your reward, whatever reward you want. If you want 1:2, 1:3, you multiply it times your ATR times the multiplier plus your entry price, and that will give you your take profit. If this is too complicated for you, you can always stick to your 1:2 or 1:3 as the case may be. Now let's look for a bearish trade. Let's look for a bearish trade and see how we can capitalize on the market when it's trending to the downside. And as you can see, this is a good example at this area. You can see price is trending to the downside at this area. You can see, even if we go further back in price, we can see that price is trending. Remember, this is your 4-hour time frame, so it's a good time frame for your swing trading. As you can see at this area, we would expect price to break this support region. This area of support should be an area we'll be looking for price to break. And once price break this area, you would see a spike. You can see a spike. You can always wait for price to come back to retest, or if you cannot wait for price to retest, you can always enter. It's not every time price comes to retest, but at the point in price, you can incorporate a retest to your trade plan, so that without any retest you wouldn't enter a trade. You would always enter a trade when you see a retest. So as you can see, if we adjusted our support level, we can see that price came back at this area to retest the support region after it broke the trade. And at this support region, when price came to retest, this would have been a good place to enter your trade. You can enter your trade at this area. You use your stop loss, you put your entry. Remember how to calculate your stop loss using your ATR indicator, your entry price minus the value of the ATR indicator at your entry price. So whatever your entry price is minus this your ATR value would give you whatever stop loss you should use. Then you aim for your 1:2 or 1:3 risk to reward, as the case may be. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. And if you found this video helpful, do not forget to like, share and subscribe. Turn on the notification bell so that you wouldn't miss out on more trading tips and strategies. Thanks for watching, and I will see you in the next video.